over to you.
Okay, so this paper is a study of some of the consequences of the financial crisis here in 2008. So Iceland was, for a time, like a symbol of the 2008 crisis. It was the first country to be hit by the crisis, and it's a tiny country, but all the banks collapsed here. It was a total collapse. The currency, the banks. We had household debt problems. The only thing which was in order were the government's finances, and that made a big difference in what followed. And so this shock then started a sequence of events and policies. And this is a study of one of the policies that was implemented in the years that followed. So I'll start with an introduction, then talk about the details of the policy, and then the data as usual, and the results and conclusions. Okay, so we think this is interesting. It is interesting outside of Iceland, because there are calls for debt relief in different countries. The Biden administration has been reducing student debt. It was a high priority policy in the US to reduce student debt. And there was even just in December, there was a reduction in the debt of public sector employees, as I understand it. So this is being done and studied. There's a literature around the student debt relief. In the US, the new Labour government in the UK aspires to reduce student debt in the UK. And there are people who say that after a big recession, debt relief is part of the policies that can help the subsequent recovery to spur consumption. So we think this study has some general interest outside our country. And now, when you do debt relief, one reason is that you want to reduce financial stress. If the banking system is under stress, there's a lot of losses on the loan book, then you can think of public policies to reduce debt. Another is to, as I mentioned, to spur demand. And so we think this is an interesting thing to do. So what we do in this paper is that we have data on all taxpayers in the country. So it's a country that now has close to 400,000 people. So it's a small country, but it's nevertheless many observations then. And we want to see how the debt relief affected household spending. I'll go into the details of the story, the politics, which is quite entertaining in a minute. But what we do is effectively to study the effect of the relief on household spending. And this was implemented, surprisingly, 7 years after the collapse of the banking system. So which is one of the key selling points for this study, is that it's done so late. Another selling point is that it's debt relief that is financed by outsiders, because when the banks collapse, and that's what happens, is you get vulture funds that buy the distressed assets. So basically you had banks that had lent money to these Icelandic banks. Then the Icelandic banks collapse. The bonds become worth much less, not zero, but they're worth less. And then the vulture funds come in and buy up the distressed assets. And then their role is to maximize the value of the assets of the banks. This debt relief was financed by taxing the vulture funds. And it helped the politicians that, the word vulture is not a nice one. You think of something bad, although they serve a very useful role. We the politician could say it's only the vultures that will pay for the tax relief. And so that was the two unique. It's sort of unique that you get someone else to pay for your debt relief, and it's done so late. And so we have two groups. One is those who were eligible for the debt forgiveness, and then the control is those that were not. So it's like a standard definitive setup. Okay, so the selling points. What makes this, in this large literature, what would make this paper interesting? It's like, why should I read this? Well, it's it was financed by foreign creditors. So it was a pure wealth effect internally. So the households in this country became better off, both in terms of net worth and in terms of interest payments overnight. And it was financed by someone outside the country. It was not a transfer within the country. Second, it was implemented when there was really no need for debt relief, because by 2015, the household balance sheets had recovered. There was no abnormal, unusual distress among households in 2015. And there was in 2009 and 10, and then there were other measures done. Like one measure was to curb mortgages to 110% of the value of the homes, so to cancel anything above 110%. There was another measure that you could take part of your mortgage and put it aside and not pay off the principal for a number of years. But this policy was in 2015 when there was really no need for it. So to have a debt relief when there's no obvious need for it is a selling point also. It's sort of strange. Not as strange as Trump invading Greenland, but it's in the sort of same category, like, why would you do this? And then the third selling point is that we have administrative data on all taxpayers in the country, and we have data on income, assets, debt, and so forth to impute consumption and saving. All right, so the findings in brief is that basically I expected when this was done in 2015 that when people get a helicopter drop of money, that they would respond by spending more. So we thought it's a bit crazy to do this. You reduce debt, they will just take on more debt and then have a good time. But what is surprising is that people who are not in distress, when they get debt relief, they respond here by actually reducing their consumption, although very temporarily, and increasing the amortization, that is reducing the debt even further. It was as if people discovered that the principal of their mortgage could be reduced. And they said, wow, we can do this. And more followed with voluntary saving to reduce the debt. So that was, so that's the main result. And this was, the amortization was larger than the leeway created by lower interest expenditures. And this is also a surprise. So this implies that households in a treatment group cut back on consumption to finance amortizations. And this is driven to some extent by highly leveraged households. Now there was some indication that, as in the U.S. studies on HARP, their debt relief program, that people responded by buying consumer durables, particular cars. So there's some indication in the results that people in the treatment group were more inclined to buy cars after the reform. But this was very minuscule. So the main effect is that they save more. So anyway, so the big picture is, here's a country whose banking system collapsed. The currency lost half its value. There was inflation, There were measures done to help households in 2009, 10, 11. Then in 2015, there's a government that said, let's tax the vultures and have a helicopter drop of money over the country to reduce mortgages. And people respond by increasing their saving, not borrowing more. So that's sort of the big picture here.
What was the reason, though? I mean, what was,
Yeah.
I guess there was a political thing going on. I mean, what was the
Yes.
reason
Yeah, the fun story is about to be told in
Okay.
one slide from here. So there's a huge literature on the effect of HARP in the US, which was basically to reduce interest spending, not the principal of the mortgages. And in that literature, it tends to be come out of that people increase their purchases of consumer durables once their monthly interest spending was reduced. But we also, because here, in our case, the interest payments go down because the principal is reduced. But then there's also a wealth effect. And then there's an enormous literature on wealth effects when house prices increase. What's the effect of consumption? There, one of the problems is that if there's a macro effect that affects both renters and homeowners, then you have to distinguish between that macro effect and the direct effect of the price of houses on consumption. In our case, we get around that because we have one group whose debt is reduced, another group whose debt is not reduced. So it's a clear policy that discriminates between people, and then we can see the consumption response. Okay, so now the fun part here is this that so we start in so before 2008, there's there's cheap money around. Interest rates in world markets are low. There are banks with a lot of money to invest in Europe. And Iceland privatized its banking system in 2003. And the new owners were, well, businessmen who also had other interests outside banking. So the banks became a vehicle for their other enterprises. And the wonderful thing about owning a bank is you can actually create money for yourself if you lend it to yourself. And you can also use because these were systemically important banks, you could use them to borrow abroad at lower interest rates than you would get if you went yourself as a person to borrow, or your non-financial businesses would borrow. So systemically important banks in a country which had a AAA credit rating, the state had never defaulted and has never defaulted. These systemically important banks were now in the ownership of people who were these ambitious businessmen who could go to Europe and borrow at lower interest rates. And the European banks would say, well, there's a spread there. We can make money by lending at slightly higher rates than we borrow ourselves. And if these banks go bust, there's a government behind them. And if the government can't bail them out, they'll go to the IMF. One way or the other, we'll get our money back. And then what happened in 2003 to 6, 7 was massive borrowing. And about 80% of the money was used by the owners and their friends to buy assets in Europe. So I used to go to London and ask myself why so many shops in Oxford Street were owned by Icelandic businessmen. Where does the money come from? And well, it came from European banks through the Icelandic banks. It was routed through that channel, and they bought iconic businesses in the center of Copenhagen. They bought shares in Saks on Fifth Avenue, American Airlines, blah, blah, blah. It was all a long list. So that was 80%. But 20% came into the domestic currency. There was a big currency appreciation. The stock market went up by a factor of 10. House prices doubled. So a massive wealth effect on consumption, plus imports being very cheap, created a current account deficit of about 25%. So a huge inflow. It's like what happened in Chile in 1980, in 1981, 82, so that, or Mexico, is an inflow of foreign money through the banking system. And having a floating currency didn't help, because that meant the appreciation created profit opportunities for foreign investors. The carry traders could actually buy Icelandic bonds. Then the currency appreciates, so they make money just from the appreciation of the currency. So you have momentum traders and carry traders. So there's a hot money inflow plus all the bank borrowing. And then in late 2007, early 2008, the carry trade unwound, so that the currency started to go down. 80% of business, that is non-financial businesses, had that in, well, 80% of the debt was in foreign currencies. So when the carry trade unwound, the currency tanked, and the domestic value of the business debt jumped. And so you had most non-financials being insolvent by early summer 2008. Then not much happened over the summer, except our people. The government was traveling around the world asking for money to the Fed, to the ECB, to the Bank of England. They were unsuccessful. And so then after the fall of Lehman in September 2008, things became desperate. One of the banks had to make a payment on its principal of a debt of some loan. In early October, went to the central bank. The government decided to nationalize it. Then there was a wholesale attack. So a run on all of these banks. So there's a modern run when foreign banks refuse to lend. There's an old-fashioned bank run when depositors in foreign branches of these banks started to withdraw money. And so they all failed in early October 2008. And then the currency had lost half its value. The banking system had collapsed. There was no currency market. There was no interbank market. And household debt had gone up because households were CPI indexed. The mortgages were mostly CPI indexed. Some of them had borrowed in foreign currencies, like 20%. 80% was indexed to the consumer price index. So when the currency tanks, the FX debt jumps, and the CPI debt also goes up, but more gradually, only as the inflation rate increases. And that approached 20% in 2009. So there's a household debt crisis that was induced by this collapse. By August 2010, inflation exceeds the Central Bank of Iceland's goal by more than 13% since December 2007. So you could say this is how much the principal of CPI index debt goes up, something which households could not have expected when they borrowed. And then what happened? There was a left-wing government from 2009 to 2013 that carried out the IMF program, which was very successful, stabilized the currency, built a new banking system, and gradually growth appeared in 2010. And the IMF behaved very well here, that we had a mission that was very supportive, gave good advice. There were no complaints. There were problems in Washington because the Brits and the Dutch, where the branches of these banks had been accumulating deposits, wanted us to the government to actually borrow from them to pay the depositors, which were huge sums by our standards. So there was a political stalemate. in Washington at the IMF. But the mission here was very helpful, and the program was well designed and it worked well. And then there were elections in 2013, and there was a progressive party. It's a sort of a party neither to the left nor the right that had been very active in fighting the claims by the Brits and the Dutch for this sort of political crisis with these countries, that demanded that our government sign a bond that we owe the UK and the Netherlands about half of GDP, because that was the total value of deposits by their nationals in these banks. Now, all of that money was paid back, but it was paid back by the state as the assets were sold off. The depositors got compensated fully, but they wanted the state to borrow immediately. What happened was that the UK compensated their depositors immediately in October 2008. The Dutch government did the same. And then the UK government and the Dutch government gradually paid all the money back from the state. But they wanted our government to borrow the money from them and pay about 5.5% rate of interest, which was very high at that time. So this party was very active in fighting the Dutch and the Brits, their claims. And in the end, a European court decided that Iceland had every right not to give in to these demands. And then, so it's like the nationalist response, that in a financial crisis, there's a lot of anger, and the anger is first directed towards bankers. But these politicians managed to divert it towards foreigners who were really not to blame for what happened. Well, except you could say the foreign banks should not have lent all this money to us. But that was the trick, is that to divert the anger towards the European Union and UK and the Netherlands, all that. So it's the nationalist, sort of the populist response, which can be very effective politically. And so then, as we approached the elections in 2013, they said, well, we should do one more mortgage relief, and let's just tax these welfare funds that had bought the bonds of our banks at these very low prices. And they made a fortune because by 2013, the price of these bonds have increased. So let's tax them and reduce the CPI indexed mortgage, because the households could not have anticipated the 13% increase in the principal because of the collapse. So if the economists couldn't see the collapse coming, how should households have seen it coming? And so let's just do the debt relief, reduce the principal by 13%, and let someone else pay for it. And of course, they win the election in 2013, and people vote with their wallet, they want money. And then there's a new government formed in, I think it was June 2013, or May 2013 there. And then 1 year later, that government has put together a proposal how to reduce the debt through taxation of foreign welfare funds. And so that was in May. In May 2014, this is approved in Parliament. And then from the summer of 2014, people could apply for this mortgage relief. It was quite neat. There was a website. You go into the website. It's part of the tax authorities. Instead of going in there to check on your taxes, you go in there to report your mortgages. And you detail your mortgages, the number, when you took out the mortgage, the principal that is left, and your bank account number and all the rest. And then in early 2015, it's just overnight, the principal is reduced. You check how much you owe, and you owe less than the night before. So it was technically well executed, and almost everyone, not everyone who was eligible, took part in it. So households that were eligible were those who had CPI index mortgages in 2008 and 2009. So those households whose principal had increased due to unexpected inflation. Now, the forgiveness amounted to 13% of the mortgage in August 2010 because inflation had been over the inflation target by 13% cumulatively from 2008 to August 2010. But it was capped. And I think this was the other party in government was trying to make this not as adventurous as was originally planned. It was capped at about 27,000 euros. So you could say the more you owed in 2008 and 9, the greater was the relief you got, but it was capped. All right, so here you can see if this is the mortgage in August 2010, this is in local currency. To get euros, you have to divide it by 100 and then some. So this is in millions here. So and here's the mortgage relief. You can see there's a linear relationship, slope 0.13, and then it's capped at 4 million. So if you didn't owe anything in 2008-9, there's no relief. The more you owed, the greater the relief, and then it's capped at 4. And now we can do I'll just show you the event study right away here. So the solid line is the debt relief recipients, and the control group is the broken line. And these are averages then for the group. So you can see that what happened here. So it's normalized so that they equal in 2014. And what happens in 2015 is that the debt of the treatment group goes down and then stays lower. And you see the gap is even increasing here between the treatment and the control. So what I had expected in 2015, I thought, well, yes, they get this debt relief, but they'll come right back up. It was manna from heaven. So why not go and spend more? And we check, now these are the mortgages. We check other forms of debt. And we only found this, as I said before, slight increase in durable consumption, that is automobile, buying automobiles financed by debt, but this was small compared to the reduction in the principal of the mortgage. Am I clear so far? So the details of this. I mean, it's basically political populism. Now, you could say, if you want to sound responsible, that people, when they borrowed, could not have anticipated these massive changes, collapse of the system happening. Yeah, you could.
Can I ask a small question?
Yeah.
This line, others, is it real value or, I mean, inflation adjusted or not?
Yeah, right. But there's a time trend, the time dummies for every year. And so the time dummy is in this broken line. There's a time dummy shared by both groups. And then there's a time dummy interacted with the dummy for the treatment that distinguishes these two. So the time dummy would be.
I mean, the mortgage.
Yeah, I think it's not, Arnaldur, I think it's not
inflation adjusted.
Inflation.
Okay, thank you.
Yeah. But Arnaldur, think about it. I think it's the correct answer that the time dummy captures, amongst other things, the effect of inflation. So if the CPI indexation kicks in here, then the mortgages increase from year to year because of inflation. If it's CPI indexed, it's reduced through paying down the monthly payments on the principal. But yeah, so that's the answer. I think it's not, so the inflation affects both over time. Right, so here we go. So the data are, we have data from the tax authorities. We have to go to the tax authorities to get a file with the debt forgiveness for every household. And this is the tax authorities that are under the Ministry of Finance. And then we had to go to Statistics Iceland, which has the tax records. By law, people in universities here can have access to data at Statistics Iceland, and Statistics Iceland make sure that we can't identify who these individuals are. And so the two data sets were linked at Statistics Iceland, and they're very careful about it. Like we don't get zip codes or postal numbers, because if there's someone earning a fortune in one postcode here, it's very likely that you could sort of induce who that person is. So we just get if they live in the urban area or the rural area or mid between. So I think there's no way we can figure out who these people are. So it's the list of people who got forgiveness linked to the tax returns, and then in the this is in the tax returns. We get the status and amortization of each household. Okay, then we use an accounting identity to calculate the savings and consumption of everyone. So we know their income, we know the value of their estate at the beginning of the year and end of the year, and debt at the beginning of the year and end of the year. From that, we can induce savings and investment. And we have, all the what the tax returns have on debt is not just total debt. We know mortgages, credit card debt, what have you, in there. All right, so this is descriptive here of the sample. So there are a total of 271,000 individuals in the tax returns. Then we have, we confine the sample to people who were between 30 and 70 in year 2014. So that reduces the sample here. Then this is split into two, it's the treatment and the control. The treatment is 70,000 people who received debt relief. And then controls are those who did not receive debt relief. And we split them into two, those who were property owners in 2014. And we do in an appendix, we do repeat the analysis for just this control group. And then in the main text, we have the full group that also includes renters. So it's renters and property owners. Because the renters, by definition, didn't receive any relief. All right, so the results here. First, there's a survey. Before we turn to the diff using the tax data, we had a company conduct a survey, and people were asked, what did you do with the debt relief? Did you increase your saving, or did you spend more? And what happened? And what came out, so this was the first indication that people responded that they started to amortize more, so to pay down the principal even more. So here you see if the green is those who got most debt relief, the red got second most, and then the yellow got least in absolute numbers, money terms. And you can see here there's So it's 50% here responded that they increased their amortizations. So there's a section in the paper that describes this, the details of the survey. Okay, now here there's an event study. So this is the mortgage for the debt relief recipients, the treatment group, and the other group. And here's the interest on the mortgages for the two groups. And so we have there's a regression of the mortgages on, so the constant term or time dummy, and then the treatment dummy, and then the treatment times the time dummy. And we make sure that in 2014, it's the same for both groups. And so you do have here parallel trends. And then the difference that arises is from the interaction of the treatment dummy and the time dummies is here. So you can see that the mortgage is reduced for the treatment and stays below the control group. Now, this is mirrored here in interest payments. Now, disposable income in the two groups, that is total income net of taxes, behaves almost identically for the two groups. Now here you have amortizations. So you see it's always the same type of event study here, the identical numbers in 2014. And here there's increased amortizations in 2015. And see this gap remains up here. And this is the amortization rate. Again, the same in 2014. There's a jump for the treatment group over here. So one has to think, if you got this debt relief and you respond by voluntarily amortizing more, what is going on in your mind? And I think this is sort of anecdotal evidence. Talking to people at the time is that they said, well, this is something that can be done. Because it used to be so hopeless with the CPI index debt. The principal kept increasing, and people have sort of a money illusion here that they don't adjust for inflation. And I said, principal is always going up. And then they realized here that it could be reduced. And paying down your debt gives you, just a speculative explanation is that reducing your debt gives you some utility. All right, here consumption, because from the tax returns, we could do consumption. You can see that the consumption of the treatment group goes down in the year that they got the debt relief. This is the marginal propensities this is by mortgage debt to property value here. So the ratio of mortgage debt to property value, and this is the marginal propensities on this axis. And so this, what this figure shows is that the more you owed, that is the higher the mortgage was relative to your property value, the greater is the effect on amortizations. So the people who owed more were more responsive to the relief. And here's consumption. It's reduced more for people who owed more, so that consumption falls more and amortizations increase more. So the highly indebted households, indebted relative to the value of their property, responded more than others. Okay, so we don't show all the charts here. We can look at the paper. And so we have this, in summary, we have this this experiment where you do debt reform financed by funds outside the economy, by foreign funds. after there's any need for debt reform. So people not in need of reform, not in distress, get mortgage relief. And the more you owe, the more you get. So it was very regressive. You see, the people with big houses and a large mortgage got more than those in small flats and lower mortgage. So a regressive regressive relief financed by others after the need had passed. There was 2015, there was a tourism boom starting. Currency had recovered, and if you compare the index of wages and index of prices, then the wages relative to prices fell in 2008, 9, 10, but by 2015 it had recovered. So real wages had recovered. So wages relative to the CPI indexation had recovered by 2015. So there was no need then. But there were the households that got relief and others that didn't get it. Those who didn't get it were those who bought a house or a flat after 2009. So if someone bought a flat in 2010, then these people had a mortgage in 2014, but they were not eligible for any debt relief. So that's one group that didn't get any relief. Those who rent did not get relief, and we can see they're in the control group when you study consumption. The control group is both those who bought after the shock and the renters. In an appendix, we changed the control group to only property owners in 2014, and that leaves the results unchanged. So the treatment is those who had a mortgage in 2008 and 9 around the crash. Within the treatment group, you have variation in intensity. So some people had a higher mortgage and got more relief. So that's sort of the setup. And what was surprising to me is that the finding suggests that people responded by amortizing more. So the principal was reduced through the relief, and then they topped it up by reducing their consumption. And this is not accounted for by their increase in disposable income due to low interest cost. And it's driven by highly leveraged, and also in the paper it shows so it's highly leveraged, high income, and liquidity constrained households. So that, I think 45 minutes have passed.
Yeah, perfect.
45.
Yeah, thanks, Gylfi. Questions? So let me just ask you one then, while people are thinking. I just try to kind of still understand the treatment and the mortgage, the treatment and the control group. So the treatment is people who got. You mentioned something like CPI. The mortgage is CPI. Is it for both groups or just for the 2009?
Yeah, okay, that has to be clear. So in this country in 2008 and before that, if you bought an apartment, you would go to your bank and you borrow money, and the principal is indexed to the consumer price index. So if there's 5% inflation,
right? So you don't have a choice, right? So everybody who borrows money, it's indexed.
Well, there's a choice. Nowadays there's a choice, but the interest rates on the non-indexed debt were sufficiently high that people found it difficult to have. It's with the non-indexed, you are, the real value of your principal is falling because of the inflation if it's non-indexed, and then the bank would want you to pay a high rate of interest. The normal interest rate has to reflect inflation, which makes it very difficult for people to borrow in an inflationary environment in non-indexed debt, because every month you have to pay not just the real rate of interest, but also the inflation part of the interest rate. And so it's easier to take the CPI index that where the inflation is just added to the principal. So that was there. So people chose, they would choose the CPI index debt. So that was the preferred mode of borrowing. There were some, just before the crash, there were some households that borrowed in foreign currencies also. Because interest rates were low on foreign currencies, but then you take on the exchange rate risk.
Okay. And then so those are the treatment group, right? So those who borrowed in 2008 and 9,
Yeah, who had outstanding mortgage, which was indexed to the CPI in 2008 and 9.
and then those who borrowed in 10, were this also CPI indexed?
Yeah, you could borrow in 2010, but then you were not eligible for any relief.
Yeah, but I mean,
Then in
I'm
the
just saying
control
that
group.
those were CPI indexed as well, the mortgages.
Yeah, they generally would be indexed also, yeah.
Okay. Now, the reason I'm asking all this is just to kind of, yeah, I know you showed the parallel trend and stuff, just to kind of understand that there are the different attitudes of people who are borrowing at different time as well. And I mean, in terms of, risk aversion or risk loving or whatever it might be. I mean, in other words, what would be the counterfactual if those who were not given the relief, had they been given the relief, would they have performed the same way or behaved the same way?
Isn't that what we would expect? But we find out the effect of the relief by comparing people who got it to those who didn't get it.
Yeah.
So
Yeah. Yeah.
it's a funny thing. I guess this is not common in other countries, but it's a tiny currency that fluctuates, and we have often high inflation, and so we can't take fixed interest rate loan for more than 3 years.
Right.
So like what do we have in Scandinavia, like 20-year fixed interest rate mortgage are not available. So if you borrow unindexed, you generally tend to pay high interest rates that reflect inflation expectations for 3 years. And people who are buying property, they just to reduce their monthly bill, they often go for the CPI indexed debt. And in 2008, that was dominant. It was that was what there was. And then when you have an inflation shock caused by the depreciation of the currency, then the principal of your debt, you see, the currency went down by 50%. You have 20% inflation in the following year. So then the principal of your mortgage goes up by 20%. And then the politicians say you could have anticipated 2.5% per year, but it was in sum over 3 years, 13% more than the inflation target for the central bank. That's the relief you get, which was easy for them because they didn't have to tax anyone to fund it. That if any voter, they taxed outsiders who.
Any other questions?
So I have a question, I think. So I think part of what was just discussed is there's sort of a selection of who chooses to get a mortgage, buy a house, and how much debt they choose to go into. And I think it was particularly important for you to compare the treatment group with the property owner control group, because those are more nearly similar populations.
Yeah.
But just so in the group where everything's indexed by the CPI, they were paying, $1,000 a month on the mortgage. Suddenly the principal goes down, so the amount they'd have to pay is no longer 1,000, it's now 800 or something. But if they continued to pay 1,000, that would reduce the amount of principal that they owed. So I'm just curious, did they continue to pay the same amount, do you think, given the results you're seeing? Or did they, cut it down?
Right.
It's someplace between what they now would be required to pay and what they were paying before.
Yeah, that's a great point. I mean, the response to your first question is yes, we did do in an appendix the control group with only property owners. So that group must then have consisted primarily of people who bought after 2009. So then you had in the treatment groups those that had bought in 2005, 6, 7, and the control group, those who had bought after the crash in 2010, both owed money in 2014. One was eligible, the other one was not. Now, the timing issue there may be partly generational. We control for age in this, but if you're 28, 30 in 2010, you buy your first property, and others bought it earlier because they're older cohorts. We did attempt to do this, what you said. But your second point, I think, is something I hadn't thought of, which is I think it's that if you the bond would specify whether you're it's usually you pay the same if it's a 3-year fixed interest bond, then you pay the same amount per month over the duration. Now the principal is reduced. Then you could say the amortization rate is increased because the denominator is reduced, and you're still paying the same as before. So then this increased amortization would simply because the denominator fell. I think, am I understanding you correctly? If you are obliged to pay monthly sums to your bank, and the principal, the debt, the mortgage is reduced by the government, then the amortization rate is increased because the denominator that is the debt is reduced. You're still paying the same money, but that money is a higher proportion of the principal. Yeah.
So would they be required? So I thought you said if they had a fixed rate mortgage, it would be a 3-year. But what if they're paying, where the house is valued based on the CPI? So do they still pay the same fixed amount for 3 years, and then it's changed based on the new value of the house after 3 years, or does it change every year, or how does that?
Yeah, so with the CPI indexation, when the principal grows from 1 year to the next, then the amount you pay, your monthly payment would increase. Yes, the monthly payment increases. So if it's 10% inflation, the principal goes up by 10%. So it's 10% higher to beginning of 25 than beginning of 24. If you don't take into account what you paid into the loan, then your monthly payment would be increased, but you're not paying the full amount of the inflation. Inflation is partly reflected in your monthly payments, but also in the principal growing over time. So, yeah, but I think
I was just saying, if you're used to paying a certain amount throughout 2024 of, I'm making up numbers, $1,000 a month.
Yeah.
Then in 2025, they tell you, well, your principal is down because we gave you debt relief. You only owe $900 a month.
Yeah.
Some people have continued to, we were paying $1,000 and it was okay with our budget if we keep paying $1,000. They're paying down the principal more.
Yeah, right. Yeah, so what we need to do is to describe in detail all these loan forms in terms of but it's to what extent the payments reflect the principal, both for the CPI index debt and for the non-indexed and all the rest. This has to be in here, and it's not in there. But I think the main results will hold because the amortization in local currency and numbers was increased. And consumption did fall, and people did save more in 2015. And in money terms, the amortization was increased. Not just the amortization rate, which would, I think, apply to your point, but also amortization in money terms was increased in 2015. So I think there's more to the results than what your question might imply, but your question is very, very useful because we need to add this to the paper, these details about the loan forms to the paper. Okay. Thanks for that. Yeah.
Any other last question, quick one?
Can I have one question?
Sure.
When we look at the effects of this mortgage relief on, say, consumption of household, why we use consumption level but not the excessive consumption above the minimum, which is needed and is independent of level of income?
Wait, the minimum consumption would be, what would that be?
Like the intercept in the equation that even if income is zero, still we have positive consumption.
Oh, a consumption function.
Something that we use this minimum as a threshold, and we look at excessive consumption, changes in consumption, the excessive part because of this mortgage relief.
Yeah. Yeah, so the increase, reduced consumption could both because of the MPC, the slope has fallen, or because the intercept has fallen. I mean, they save on interest expenditure, so they have more income. Yeah, the intercept must have fallen. Yeah, so that's another good point. So we should write this. Arnaldur, I hope you're writing down the. Yeah, so how is it in the consumption literature? There's in a cross section, the consumption function different than in time series. This was Friedman's paper in whatever 50 something. That so in the cross section you would have the intercept. So we could have a consumption function for each year for both groups, and see how the cross section. So the consumption function, like the textbook function for both groups, and if the one for the treatment group falls, the intercept falls. Yeah, that would be beautiful. I think we can do that. That's what you're thinking?
I was thinking of like even if in difficult situation consumption doesn't go to zero, like the excessive part of it is changed, not the minimum or basic part. That was my. I'm not familiar with this literature. Sorry, I just wondered.
Yeah, in the crisis, there was consumption smoothing in the crisis, so so inflation, the consumption fell less than disposable income, and then it recovers after the crisis, and then you have the treatment and control, and the treatment reduces its consumption. So the intercept must have fallen temporarily for the treatment group. Yeah.
Thank you very much.
That would be fun to do that. There's the Friedman type or textbook type consumption function, how for two groups, how they move over time, the slope and the intercept. Yeah. So we are fortunate to live in a country with many natural experiments. Sometimes you have natural experiments like volcanic eruptions. They also give you papers, and this is policy created experiment that is interesting because it's so crazy. So, We
It
must,
was, yeah, crazy policy. Thank you very much for a very interesting paper and talk. And that is kind of unusual what happened, and so it's quite nice to see the paper. But yeah, thanks a lot, Gylfi, for giving us the time. And until next month, I think we should say goodbye. Thanks very much.
yeah. Okay.
Bye, bye,
Well,
everyone.
thank